Okay, we start today's market talk. Traders are brain warriors who fight and win with their ideas. So you have to think unconventionally because the data that exists in public domain seldom gives you an edge as it is already discounted. So you have to think faster, further, and more accurately about where the price could be at a future time frame. Keep your ideas sharp so as to be able to stay ahead of the crowd. Now, market outlook as I see it, continuity has been warmly welcomed by the markets. There is nothing better than a continuation of old business friendly policies for the market. Though there is some distress on economic front, but the first decisions, if you see, of the new government have been to allocate funds to farmers and housing for the poor. Now, lower than expected US retail as well as US producer price inflation came in, and Fed tried to play spoilsport by pruning its forecast of the number of rate cuts this year from 3 to 1. So FOMC projected one rate cut this year. Last time, if you remember, they had projected around 3. The point is underlying demand is strong in US. Labor market has better balance. Lower than expected CPI came for May came as a surprise, led to another higher expectation of a rate cut in September and maybe one more at the end of the year. So that is what is giving momentum. This led to decline in bond yields and rally in equities. The message from the Fed is very clear. US economy is strong. If anything goes wrong, they have the economy's back or Fed put us back. And the market celebrated. Now, housing has got a push from the new government. Uh, uh, there is a elevated budget allocation which should be beneficial for affordable housing. Cabinet nod has come for 3 crore additional rural and urban houses. Stocks of most housing finance companies have already rallied since my post-election recommendation. Still, you can look at Aadhaar Housing, Aptus Value, Awas, Home First, India Shelter, Repco Home, LIC Housing, which is the largest player. They have highest names and return on assets. Though this lending is done by all PSU banks and also this place is very crowded. Now, the other sector which was in focus was the cement industry. There is a wave of consolidation which is sweeping the Indian cement industry as regional companies struggle to compete with the industry leaders. I'll show you in detail also. Ambuja Cement announced the acquisition of Penna Cement, a Hyderabad-based company. Acquisition will augment its presence in the fragmented southern market and bring the Adani Group closer to its goal of achieving 140 million tons capacity by 2028. Now, the point is that cement sector has to be looked at from regional point of view, not from pan-India point of view. So the prices are also moved as per the regions. Like if a price may go up in northern India, but may not go up in southern India. And since there is a weight associated with the product, hence the southern demand is met by companies in the southern India only, or the northern demand is met by companies in the northern part of the country only because of the weight of the product. So all of them, all the big players are working on commissioning of new capacities and fighting for market share, which is putting intense pressure on realization on a pan-India basis. Sectors which were favored in the last 1 or 2 years should continue to do well as the overarching theme of Make in India remains in focus. While choosing domestic manufacturing themes, we must consider the supply-demand mismatch also, like in cement, paint, renewables, and moderation in order book in railways. Focus on value add or margins in electronic manufacturing and stock valuations. So we cannot just go crazy on Make in India theme. Valuations, margin of safety remains the single most important criteria while taking fresh trades. Now, if you see here, this is the bond yields for Indian government bond yields. So if you see here, it's in a declining trend line and it declined last week. It came down to 6.984 level, which clearly shows that the bond market is penciling in or is very comfortable with the present situation, and hence the bond yields came down. Now, when the bond yields come down, it favors basically PSU banks because they are the largest holders of bonds, and it will subsequently benefit their stock prices because they make market to market gains, all these banks who are holding the government bonds. So that is one understanding out of this. Now let's talk about US. US indices had a good week on back of surprisingly soft inflation data. Fed signaled, as I told you, just one rate cut from a forecast of 3, and Nasdaq climbed 3.5%. Apple surged 7.3% on Tuesday after it announced integration of OpenAI ChatGPT to its voice assistant Siri at no extra cost. So if you see here, this is a weekly chart. So US bond yields declined, and now they have come to their 50 EMA, 4.22. I think if the same thing continues, it should decline further. The trend is down right now, so that is helping all the interest rate sensitive stocks and commodities. Now the dollar index, it went up but it came down also, so there was some strength in the dollar index. It is also because of weakness in other currencies against which it is pegged against, that is the Japanese yen and euro, etc. Brent crude had a slight rise. This is basically because there is a hurricane season which is coming up in US, so but there's nothing substantial. Gold, because the bond yields came down, so the gold again went up above 2300. It had come down below that. Nasdaq, as I told you, this time now after Nvidia, now Apple has taken it up. It's at fresh all-time high and has broken above this rising trend line. So now it is likely to go up because all the big stocks are doing very well in US. Now copper, this though base metal should do well, this is one where now there is likelihood of a oversupply and it is correcting. So I would recommend to get out of positions in case you have in copper or in Hindustan Copper with whatever profits or whatever you have, because this is likely to correct and test the 20 EMA. India VIX, which had gone to around 30 odd levels last week, has declined and has now come to 12.82, and now it's below the 20 and 50 EMA, and I think it should test this 10 and 11 level where it should stabilize subsequently. So the scenario is not very good for basically option buyers right now. Now coming down to our indices, Nifty 50, if you see here, it made a big a dragonfly candle kind of candle on last week, but this week the candle was higher than that. So till the time it is above the low or the high of last week, it is strong. So this 23,200 odd level should be a decent level to watch out for. It is trading above over a period of time. In medium term, it should trade higher only because it is above the, on weekly chart, is above the 20 EMA. So this is looking slightly better as an index because it has gone above the level of the last week. Now coming to the daily chart. So if you see here, 1, 2, 3, 4, 5 days. All days, every day there was a gap up and then there was a sell-off. And on Friday, we had a dragonfly doji, which generally indicates a trend change. Now, subsequent candles will have to be seen to see which direction the trend is going to change into. What it indicates is aggressive selling during the period of candle. But since price closed near the open, it shows that buyers were able to absorb the selling and push the price back up. So we'll have to watch this now as to which direction it goes. This is the hourly chart of Nifty 50. So if you see here, it had a rise in last week. Then on 10th onwards, it opens gap up, then it sells off, then it recovers during the day, and then sells off at the end of the day. Again, a gap up, same selling off, again a gap up, selling off, gap up, then sell off. Similar thing, gap up, then immediately gap up, and then immediate sell off, and then sideways throughout the day. So it indicates that at higher level, there is supply, the selling is coming. Maybe people who are already long, who had gone long in last week and all, they are squaring off their position, hence the supply comes and the price goes down. Now Nifty Bank, if you see here, it's a weaker chart. This is still below the last week's candles high. So it indicates some weakness. Again, the same thing, it shows selling at higher levels. Now let's see the daily chart. Now if you see here, it had three green candles and three red candles and two green candles. And again, it made a kind of a dragonfly doji on Friday. Same reason. So basically, we have not been able to overcome the candle of 4th June. This big red candle of 4th June has not been overcome yet. So it has to break out above this candle for showing some strength. Supply, again, there's a supply from people trapped at high levels. So one has to watch out for these levels. For this high which it had made on 3rd, 51,123 or 113 or so level has to be achieved, and then only there will be strength on Bank Nifty. Now, if you see HDFC Bank, this is a daily chart. HDFC Bank showed some strength on Friday. There is a gap here from 1600 to roughly 1640 odd levels. There is a gap here. So this gap has to be filled. Once it goes above this, then it will test its high and go up to that 1700 odd levels. So this gap will be the clear resistance here. Reliance, I had showed you last time. This is from 3000 to roughly 3000, 2030 is again a resistance zone. It has number of times fallen from there. So these are at cusp of this. So if it doesn't breaches this, then it will has to come back, test the average, and then again bounce back from there. Now, one stock which was in momentum last week was GMR Airports. Now see here, this is the last high. So it has to break above this 93, 94 levels to go into 3 digits level. Otherwise, it goes up to that level and comes back and tests its moving averages, 50 or 100 day moving average, and then bounces back. So just watch out for this. It is in FNO ban. So that was one reason why it is not going up. So let's see. Midcap index, this was one index which has overcome the decline of last week and is looking up and has made a fresh all-time high. Same with small cap index also. Again, it is up and made a fresh high. So these are the ones which are showing strength, and that is why basically the portfolios did well last week. because the mid cap and small cap indices were doing well. Now I'll cover a few stocks today. First is basically an outlook on cement sector. Uh, it's upbeat on industry volumes with India growth story resonating well. However, cement price movement continues to remain a key monitorable. Amid the current volatile and evolving industry environment, stick with players who either operate at strong leverage positions and stand a better chance of exploring attractive inorganic opportunities, or the players who offer healthy valuation comfort. What it means is those who don't have too much of debt, have cash on their books, so there are so many strong smaller inorganic opportunities, small players all spread all over the country, which are available for acquisition and subsequently restructuring of their businesses. Or if you are looking, then look at the ones which are not trading at very high valuation. So this is the basic point. Aggressive expansion plans to ensure continued outperformance by big organized players. Now I'll show you that the big five in this cement sector, they have roughly more than 70% market share. Volume growth rebounded for cement industry in fourth quarter as top 16 listed cement players, 85% of industry sales volume, reported 11% year-on-year volume growth. Average Average power and fuel cost per ton came off 8% Q-on-Q due to lower power costs. This, along with operating leverage benefits, led to 7% year-on-year and 3% Q-on-Q softening in average total cost per ton for the industry. But the management commentaries from all of them alluded to weak pricing and demand in first half of FY25 owing to elections and monsoons, and they expect recovery in second half only. So the point is, this quarter's results will be weak. So be careful, because all these stocks are now running up very high because of too much of enthusiasm with this sector. Now, if you see here, this is the volume growth of the top five players. Now, who are the top five players? They are Ultratech, ACC, Ambuja, Shri Cement, and Dalmia Bharat. So if you see here, they have nearly 14% growth, while rest of the guys are at 6 or 7% only. So volume growth is higher for the bigger ones because they are more efficient, they have better logistics and all those other issues. And just see the market share trend. This is from FY18. So from below 70%, now it is above 70% for these big five. So they are grabbing market share as even the supply and demand has also increased. Now, one of the reasons why the profits were higher in fourth quarter was the input prices came down. Domestic petcoke prices, they are falling in terms of rupees per ton, and imported petcoke prices were also declined roughly 15% from December 23 levels, which you can see from the chart here. Now, let's see the valuation in terms of EV per ton. Now, these large cap ones, Ultratech, ACC, Ambuja, Shri Cement, and we can say Dalmia Bharat, you can see the difference in valuations of the larger ones as compared to the bottom part. So they are at much higher valuation in terms of EV per ton. And then the lower people, and one stock which I am going to discuss slightly in detail, JK Lakshmi, it is at 76. Just remember that EV per ton. Just remember this Penna deal has been done at $80 per ton. So that is just a reference. So all of them which are below 80 should get re-rated now. Now this is older price, so maybe it has gone up a bit now. Now talking about comparable valuation in terms of EV EBITDA. Now if you can see here, Ultratech, ACC, etc., they are even at EV EBITDA per ton also. They are comparatively higher as compared to uh, the ones like JK Lakshmi, Birla Corp, Nuvoco, etc. So they are at much higher valuation. And if ROE wise, if you see here, uh, they are good. JK Lakshmi, etc. They are still good in terms of ROE. Dividend yield is the same. Only thing is that they have got higher volumes and higher growth potential. Now, coming to operating parameters of these people. So, if you see here, this is the reason why these guys are trading at a higher valuation. If you see here, ACC volume growth 22%, Ambuja 17%, as compared to JK Lakshmi, where year on year it declined, though Q on Q it was higher. Ultratech Cement 10% year on year and 28% Q on Q. So actually, it is basically because of the higher growth which is coming, they are getting higher premium. This is the realization, and this is the actual value, EBITDA per ton for them. This is their earnings actually, how much EBITDA they are earning, operating profit per ton of cement they are selling. So if you see here, higher the better out here. So if you see ACC, it's still at 800 odd, and JK Lakshmi is at 1000, and Ultratech is at 1173. That shows they are more efficient. And Shri Cement, if you see, is the best, 1393. Star Cement is at 1296. So some of them are very efficient also, and efficiently doing cutting down their cost and getting, because the price they're getting is the same. So actually one has to cut down the cost. Now, first, volume push, which we have seen, was the key industry focus in fourth quarter, which impacted realizations on pan-India basis. Cement prices tumbled 5% sequentially. So what people were talking about, a high rate hike didn't take place. Maybe subsequent to monsoon, etc., they would be able to do a price hike. Industry average EBITDA per ton is 800 rupees, 800 per ton. So anything above that is good. I told you the top 5 players are having highest growth, and they are grabbing market share from rest of the industry in the last 5-6 years. Additional capacity additions will come via organic and inorganic route. Pan India cement prices are lower as compared to fourth quarter FY24. International petcoke prices, power and fuel costs have corrected 8%. Freight costs came flat at Q on Q. Freight cost is a big factor for cement companies. So total cost of the industry came down by roughly 7%, and that led to higher EBITDA per ton and better margins and profits for the cement company. Now let's see these 3 cement stocks charts I'm covering. Ultratech Cement, it had a breakout post June, and it has gone up to now roughly 11,000 plus levels. It has broken above this all-time high, and now it has gone up. The other one, ACC, it made a low of around 22 odd hundred, and now it has come to 2600. So it will be a fresh high. So this is relatively cheaper as in terms of capacity and growth. The other one is JK Lakshmi. As I was covering, the smaller player, it is trying to rise above this declining trend line. The prices declined, though EBITDA per ton was higher, but basically because of lower volumes. So this price declined, but this is expected to do better. So once it breaks out above the this declining trend line, so one has to get them, considering that the next few quarters would not be very good for them. Now, among the affordable housing finance companies, so I'll cover one today, which is India Shelter Finance. They have a penetrative expansion strategy with focus on underserved customer group. Now, tech integration is enhancing operational efficiency. 92% digital collections, 99% e-natch mandates. Now, this is basically electronic national automated clearing house to track and clear recurring debits and credits. So there's nothing great. It is there with all, wherever you have a longest EMI, you have this, you have to give this mandate. 98% e-signing in FY24 speak for technical penetration levels which are very high. Now, this is the point where there should be a concern, primarily caters to self-employed individuals. So that one has to be careful. 72% of AUM as of March 24 is of these guys, with focus on first-time home loan takers, 70% of the borrowers. In low and middle income group segment, 76% of borrowers. Present across tier 2 and 3 cities, 90% of the borrowers. As of March 24, the company had 223 branches spread across 15 states and union territories. Notably, these 15 states constitute 94% of overall mortgage market. Strong underwriting processes with comfortable asset quality metrics. The other good part about their technical capability is they have lowest turnaround time of 4 days between onboarding to sanction, which is the best. But actually, that makes hardly any difference. It is the how good or bad your underwriting is, because subsequently you'll get saddled with NPAs and all that. So that is most important. They are having separate apps for customer acquisition, underwriting, collateral valuation, collections, and customer service, etc. So let's see how they do subsequently from here. Now, if you see here, profit and loss, this is in millions. So they are expected to do around 1300 crores of income for FY26. And they would do around 435 crores of profit. They have borrowings, but they are still okay because you have to borrow money. But I'll show you here, the AUM is rising. So that is good, roughly 11,000 odd crores. Total AUM growth would be around 35-36%. Operating profit is expected to grow 30, around 32%, so roughly 30 odd percent growth, and PAT growth is also the same part. NPAs are under control, expected to be around 1.3 odd. ROA is good, 4.8, ROA is 15.3, so that is good. EPS is expected to be around 40 odd in FY26, but the key issue is the book value. Book value expected to be around 250 to 280 over the next 2 years. Presently, they are at price to book of around 2.3, but they can easily trade at price to book of 3 if they show good growth. AUM, if you see here, crossed 60 billion rupees, that means 6,000 crore in FY24, and is expected to go at 40% CAGR for the next few years. Consistent improvement in productivity with higher growth. So the AUM per branch is now 27.3 crore versus 18.1 crore, which was there earlier. So they have become more efficient. So disbursement per employee is also higher. So that is good. NPAs have come down over the last few years, so which is pretty good. Asset quality has improved. Slippages have been reduced. Share of bank borrowing and direct assignment increased in last 4 years, which has cost of borrowing has only gone up by 40 basis point against 250 basis point rate hike for last 3 years. So which has kept their profits good, and because they have changed the way they are borrowing now. So that is the good part. Now, if you see their chart, this is a recent listing. So it went up to around 720, then corrected. And then this is for June. So that's what I sold that day also, that get into housing finance. So it made a low of around 560 and has had a vertical rise to nearly 700 plus levels right now. So at 3 times price to book, it can go to around 800 plus. So that is good, but this has to, if you have to accumulate this, one has to get it at closer to the moving averages. That dip will come because right now it has had a vertical rise. Now the other stock which I am covering today is Jindal Stainless. Uh, the company's product range includes ferroalloys, stainless steel slabs, hot rolled strips, plates, cold rolled products, and other products such as precision strips and razor blade steel. It operates and manages stainless steel manufacturing facilities at Hisar, Andhra Pradesh, Odisha, and Indonesia. Jindal Stainless profitability is expected to remain solid in future. However, will be impacted from near-term demand slowdown in export markets and lower stainless steel prices. It announced capex of 5,400 crore to augment its melting and downstream facilities in order to reach a capacity of 4.2 million tons per annum. This includes a 49% partnership in a joint venture of 1.2 million tons per annum melting shop in Indonesia, expansion in downstream capacity in Jajpur, Odisha, and acquisition of a 54% equity stake in Chromeni Steels in Mundra, Gujarat. So they are doing a lot of acquisition, basically brownfield acquisitions, which is good, and they are doing a lot of joint partnership. And this joint partnership is very interesting. I'll cover this subsequently. Uh, the stainless steel demand continues to remain robust in India, but demand is muted in Europe and US due to Red Sea crisis. Volume stood at 0.57 metric ton up to million tons, up to 11%, up 11% Q on Q. Exports contributed 11% of total sales. Management maintains 20% year-on-year volume growth in FY25 and 26. Management guided EBITDA per ton of 18,000 to 20,000 rupees per ton in FY25. Now, let's see. So, if you see here, the revenues and EBITDA declined Q on Q in fourth quarter. And even Q on Q also, the EBITDA declined. For FY24, the EBITDA was roughly 4,700 crore. It is expected to go up substantially over the next 2 years, basically because of acquisitions. So it is not because of organic issues it is going to go up. It is going to go up because of acquisition by roughly around 1,900 crores. That is the EBITDA. Margins are remaining the same. Net profit declined. And EPS also declined Q on Q and year on year. So this one has to keep in mind. Because of better operating leverage, etc., and higher profits, the PE is going to come down because EPS is going to be higher, substantially higher. Good EPS growth over the next 1 or 2 years. And ROEs are expected to improve. ROE is expected to reach around 25%, which will aid the profits. Now, if you see here their Q on Q performance, the revenue has declined year on year because the reasons I mentioned, lack of demand and lack of pricing. EBITDA declined again despite JUSL acquisition. JUSL is Jindal United Steel Limited. It's another plant of this company. So despite that, EBITDA declined. Volume increased by 12% year on year. EBITDA per ton came down 19.4% to 18,150, though they are trying for 20,000 plus levels. So if you see here, revenues have declined, volumes are higher, EBITDA has declined, and EBITDA per ton has declined. So this is leading to decrease in profits. Now, if you see here, what is expected is revenue growth of 45% because of acquisitions and EPS growth of around 61%. Margins are expected to remain the same. ROE is, as I told you, improving. And EPS is expected to be around 50 in FY25, but I will take it with a pinch of salt. It may be anything between 45 and 50. in FY25. And I don't want to look at the commodity thing more than 1 year, because the things change very quickly out here. So considering this is one of the brokerages which has done a valuation. They have given a target price of around 647, so it is still already higher, because traditionally it trades at 7 times EV EBITDA. So if we have seen, EBITDA is likely to be 78637 millions in FY26, giving a multiple of 7, enterprise value, net debt added, implied market cap divided by number of shares. So they have come to a price of 647. So if you see here, EBITDA per ton has declined. Q on Q 27% and year on year 32%. So that should be a concern. That there is despite better volumes, sales volumes which are improving 11 and 12%. Despite that, the EBITDA per ton has gone down. So that should be a concern, because the prices are declining. They have under control the borrowings, and they are reducing their borrowings now. So net debt is likely to decline by 18% over. It has declined in this quarter, so that is positive. Now let's see their chart. This has had a vertical rise and traded always above the 20 EMA, and now it has reached 812 levels. So there is something which we are missing, or something like that, because the stock continues to go up. There is a EBITDA per ton has fallen, and this standalone EBITDA per ton is the lowest since 2020 and has declined by 27.3% Q on Q. Debt has declined. Profitability to improve, factoring incremental EBITDA through acquisitions. As I told you, ROE is strong. What they are doing, as I told you, in Indonesia, is collaboration with Tsingshan, which is a Chinese company, world's largest stainless steel player, which is going to lead to positive ramification for this company. They are setting up 1.2 million tons per annum plant in a joint venture with Tsingshan at a much lower capex than what they are doing, a brownfield expansion in Jaipur. So that is very positive. The only point concern would be if a duty is put on import of stainless steel from Indonesia to India. So that would be a concern. But if the plant starts working in FY26, so that should improve their, since it's at much lower price cost, so that should improve their profits. I have finished. We'll take questions now.